Getting richer faster than your neighbor feels more important than getting richer. This psychological trap destroys more wealth than market crashes, economic recessions, or poor investment choices because it transforms wealth building from a positive-sum game into a zero-sum competition. When success becomes relative rather than absolute, the focus shifts from building wealth to beating others, and this shift in focus leads to decisions that feel satisfying but prove financially destructive over time. I discovered this watching two neighbors navigate identical market conditions with fundamentally different definitions of investment success. Both were intelligent professionals with similar incomes and financial goals, but they measured progress in completely different ways. One focused obsessively on relative performance, beating benchmarks, outperforming peers, looking smart compared to others. The other focused exclusively on absolute wealth accumulation, getting richer steadily regardless of how others performed. Their contrasting approaches revealed why comparison is the enemy of compound returns. Robert Sterling was a successful marketing director who approached investing like a competitive sport where the goal was beating the market and outperforming other investors. Robert subscribed to multiple investment newsletters, tracked his portfolio performance against various benchmarks daily, and felt genuine satisfaction when his returns exceeded the S&P 500 or his colleagues' investment results. Robert's investment philosophy was explicitly competitive, identify opportunities that would generate superior returns compared to passive strategies, time the market to capture gains while avoiding losses, and build a portfolio that would make him look intelligent and successful compared to average investors who simply bought index funds. Robert spent significant time researching individual stocks, analyzing market trends, and developing trading strategies that might provide edges over institutional investors and amateur stock pickers. He felt proud when his stock selections outperformed the broader market and frustrated when simple index fund strategies generated better returns than his carefully researched positions. His neighbor, James Liu, had a completely different approach that Robert initially found boring and unambitious. James treated investing as a wealth-building process where the only relevant metric was whether his net worth was increasing steadily over time. He never compared his returns to market benchmarks or other investors' performance because he viewed wealth building as an individual journey rather than a competitive contest. James's investment philosophy was explicitly non-competitive, achieve reasonable returns consistently over long periods through low-cost diversified strategies, ignore short-term market movements and peer performance comparisons, and focus entirely on reaching financial independence through systematic wealth accumulation, regardless of how quickly others achieved similar goals. James invested primarily in broad market index funds, rebalanced annually, and measured success by whether his portfolio value was higher each year rather than whether his returns exceeded any particular benchmark or peer comparison. He felt satisfied when his wealth increased and untroubled when other investors generated higher returns through different strategies. The psychological difference between their approaches was profound and revealed itself in their daily investment behavior. Robert checked his portfolio multiple times daily, compared his performance to market indices constantly, and felt emotional highs and lows based on relative performance rather than absolute gains or losses. Robert's emotional state was directly connected to comparative performance metrics that changed hourly. When his portfolio outperformed the S&P 500, he felt intelligent and successful. When it underperformed, he felt frustrated and began questioning his investment choices, even if his absolute returns were positive. James checked his portfolio monthly, focused on total account value rather than performance metrics, and felt emotional satisfaction from steady wealth accumulation regardless of comparative performance. His emotional state was connected to absolute progress toward financial goals rather than relative performance against external benchmarks. The comparison obsession affected Robert's decision-making in subtle but costly ways. When his portfolio underperformed the market for several months, he would abandon successful long-term strategies in favor of different approaches that might generate superior relative returns in the short term. Robert's pursuit of relative outperformance led him to take unnecessary risks, chase performance trends, and make frequent portfolio changes that increase costs while reducing long-term returns. His competitive mindset encouraged active management that felt intelligent but proved counterproductive over time. James's absolute focus enabled him to maintain consistent strategies regardless of short-term underperformance relative to benchmarks or peers. His non-competitive mindset encouraged passive management that felt boring but proved effective for long-term wealth accumulation. The first major test of their contrasting approaches occurred during the 2018 market correction when both portfolios declined, but at different rates. Robert's portfolio fell 12%, while the S&P 500 fell 15%, creating a situation where he experienced absolute losses but relative gains compared to the broader market. Robert felt genuinely satisfied with his 2018 performance because his active stock selection had enabled him to beat the market by losing less than the benchmark index. He viewed his relative outperformance as validation of his research-intensive approach to portfolio management and evidence that active strategies could provide protection during market downturns. James's portfolio fell 14% during the same period, closely tracking the broader market performance because of his index fund approach. James felt disappointed about his absolute losses, but untroubled by his underperformance relative to Robert's portfolio because he viewed short-term fluctuations as normal parts of long-term wealth building. The psychological impact was revealing. Robert felt successful despite losing money because his losses were smaller than the benchmark comparison, while James felt neutral despite losing slightly more money because he focused on absolute rather than relative outcomes. Robert's satisfaction with beating the market during a declining period illustrated how relative thinking can create emotional rewards that don't correspond to financial reality. He had lost 12% of his wealth, but felt good about his investment performance because of comparative rather than absolute metrics. James's neutral response to underperforming Robert's portfolio during the decline illustrated how absolute thinking provides emotional stability that corresponds to financial reality. He had lost 14% of his wealth, but maintained perspective about long-term wealth building that didn't depend on comparative performance. The 2019 market recovery revealed additional psychological traps created by comparison-focused investing. Robert's portfolio gained 18%, while the S&P 500 gained 22%, creating a situation where he experienced substantial absolute gains but relative underperformance compared to simple index investing. Robert felt frustrated and disappointed with his 2019 performance despite generating significant absolute returns because his active stock selection had failed to beat the market during a favorable period. He began questioning his investment approach and considering different strategies that might provide better relative performance. James's portfolio gained 21% during 2019, closely tracking market performance and generating substantial absolute returns that brought his net worth to new highs. James felt satisfied with his wealth accumulation and untroubled by questions about whether different strategies might have generated slightly better returns. The reversal was psychologically jarring for Robert because his focus on relative performance created emotional dissatisfaction despite strong absolute results. He had earned 18% returns but felt unsuccessful because index fund investors had earned 22% returns with less effort and research. James's satisfaction with absolute results illustrated how non-comparative thinking provides emotional rewards that align with financial reality. He had earned 21% returns and felt good about his investment performance because his wealth had increased substantially regardless of comparative metrics. Robert's disappointment with relative underperformance led him to modify his investment approach by reducing individual stock positions and increasing allocation to growth-oriented funds that might provide better performance during continued market appreciation. His strategy changes reflected pursuit of relative outperformance rather than optimization of absolute returns. James maintained his existing strategy because his absolute results were meeting his wealth-building objectives. His consistent approach reflected focus on long-term financial goals rather than short-term performance comparison that might encourage counterproductive strategy modifications. The pattern continued through subsequent market cycles as Robert's comparison obsession created emotional volatility and strategic instability that reduced his long-term returns despite periodic relative outperformance. His competitive mindset encouraged frequent strategy changes that felt rational but proved costly over extended periods. James's absolute focus created emotional stability and strategic consistency that enhanced his long-term returns despite periodic relative underperformance. His non-competitive mindset encouraged steady execution that felt boring but proved profitable over extended periods. Social interactions revealed additional costs of comparison-focused investing as Robert's competitive approach affected his relationships with friends and colleagues who discussed investment performance. Robert felt superior when his returns exceeded others' results and inadequate when others generated better performance through different strategies. Robert's investment conversations became subtle competitions where he sought validation for his approach while questioning others' strategies that outperformed his own. His need to win comparative contests made investment discussions stressful rather than educational because he couldn't learn from others without acknowledging relative underperformance. James avoided investment performance discussions because he viewed them as irrelevant to his wealth-building objectives. His non-competitive approach enabled him to learn from other strategies without feeling threatened by their success because he wasn't measuring his progress against their results. Professional management illustrated similar dynamics as both neighbors considered hiring financial advisors who marketed their services using relative performance claims. Robert was attracted to advisors who promised to beat the market and outperform passive strategies, while James sought advisors who focused on absolute wealth building through cost-effective, diversified approaches. Robert eventually hired an advisor who charged 1.5% annual fees while promising superior returns through active stock selection and tactical asset allocation. His advisor's marketing emphasized relative outperformance against benchmarks and peer comparisons that appealed to Robert's competitive mindset. James hired a fee-only advisor who charged flat annual fees while providing comprehensive financial planning focused on absolute wealth accumulation through low-cost index funds and tax-efficient strategies. His advisor's approach emphasized long-term financial security rather than relative performance metrics. Over 5 years, the cost difference was substantial. Robert's advisor fees totaled over $15,000, while generating returns that occasionally beat the market but averaged slightly below market performance after fees. James's advisor fees totaled $8,000, while generating returns that closely tracked market performance with minimal drag from fees. Robert's pursuit of relative outperformance through professional management had cost him over $7,000 in additional fees while generating inferior absolute returns. His competitive approach had led him to pay higher costs for worse results because he prioritized relative performance over absolute wealth building. James's focus on absolute wealth building through cost-effective management had saved him thousands in fees while generating superior absolute returns. His non-competitive approach had enabled him to achieve better financial outcomes by prioritizing cost efficiency over performance marketing. The retirement planning phase revealed the ultimate costs of comparison-focused investing as both neighbors approached financial independence with different wealth accumulation trajectories. Robert's competitive approach had generated periods of relative outperformance, but also periods of relative underperformance that averaged out to market returns before fees and taxes. Robert's frequent strategy changes had created additional costs through transaction fees and tax inefficiencies that reduced his long-term wealth accumulation. His pursuit of relative outperformance had prevented him from capturing the full benefits of compound returns through consistent long-term investing. James's consistent approach had generated market returns with minimal costs and maximum tax efficiency, enabling him to capture the full benefits of compound returns over extended periods. His focus on absolute wealth building had positioned him for earlier retirement despite never attempting to beat the market. The final comparison was revealing. After 20 years of investing, James had accumulated 35% more wealth than Robert despite never trying to beat the market or outperform peer investors. Robert's competitive approach had felt more sophisticated and active, but had proven less effective for actual wealth building. Warren Buffett's investment philosophy exemplifies the absolute approach by focusing on business value and long-term returns rather than benchmark performance or peer comparisons. Buffett has consistently ignored relative performance metrics while building enormous wealth through patient focus on absolute business results. Buffett's famous advice to never ask a barber if you need a haircut applies directly to investment performance comparisons because comparative metrics encourage unnecessary activity that benefits service providers more than investors. The focus should be on absolute wealth building rather than relative performance gaming. Charlie Munger's approach to investment evaluation emphasizes absolute business quality and reasonable prices rather than relative performance against arbitrary benchmarks. His success reflects understanding that wealth building is an individual journey rather than a competitive contest against other investors. Academic research consistently shows that comparison-focused investing leads to inferior results because it encourages active management, frequent trading, and performance chasing that reduces returns through increased costs and behavioral errors. The investors who achieve superior long-term results are typically those who ignore comparative performance metrics. Professional money management suffers from comparison culture because institutional investors are evaluated based on relative performance against benchmarks and peer groups rather than absolute wealth building for their clients. This evaluation framework encourages strategies that look good comparatively but often prove suboptimal for actual wealth accumulation. Individual investors have advantages over professionals because they can focus entirely on absolute wealth building without pressure to justify their performance relative to arbitrary benchmarks or peer comparisons. But most individual investors surrender this advantage by adopting competitive mindsets that prioritize relative performance over absolute results. The financial media amplifies comparison culture by constantly reporting which investments, strategies, and advisors are beating the market or outperforming peers. This comparative framing encourages investors to view wealth building as a competitive contest rather than a personal journey toward financial independence. Social media has intensified comparison culture by providing platforms where investors can share performance results and compare strategies publicly. These platforms encourage competitive behavior that feels engaging, but often leads to poor investment decisions based on envy, pride, and social pressure, rather than rational wealth-building strategies. Robert learned this lesson gradually as he recognized that his competitive approach was creating stress and reducing returns compared to simpler alternatives that James had used successfully. His eventual shift toward absolute thinking improved both his investment results and his emotional satisfaction with wealth building. James continued his non-competitive approach while helping friends and colleagues understand that wealth building success should be measured individually rather than comparatively. His consistent results and emotional peace provided compelling evidence that absolute thinking generated better outcomes than relative competition. The comparison prism has many entrances but few exits because escaping requires abandoning the emotionally satisfying but financially destructive habit of measuring success relative to others rather than against personal financial goals. Most investors remain trapped because competitive thinking feels natural and socially acceptable. The key insight is recognizing that wealth building is a positive-sum game where everyone can succeed simultaneously, unlike competitive contests where one person's winning requires others to lose. This understanding transforms investing from stressful competition into peaceful wealth accumulation. Individual investors can escape comparison prison by focusing on absolute progress toward financial independence rather than relative performance against benchmarks or peers. The relevant questions become, am I getting richer and will I achieve financial security, rather than am I beating the market or am I outperforming others? The most successful investors throughout history have been those who ignored comparative performance metrics while focusing obsessively on absolute business value and long-term wealth accumulation. Their success reflects understanding that getting rich slowly is more valuable than trying to get rich faster than others. Robert and James both discovered that the path to financial independence runs through absolute thinking rather than relative competition. The investors who understand this principle build lasting wealth by focusing on their own journey rather than comparing their progress to others' different paths towards similar destinations. The comparison trap promises social status and emotional satisfaction in exchange for financial performance, but this trade proves expensive because social status is temporary, while compound returns are permanent. The investors who prioritize compound returns over social comparison are the ones who achieve both financial success and genuine satisfaction. Investment success isn't about beating others, it's about reaching your own financial goals through patient wealth accumulation regardless of how quickly others achieve similar results. This shift in perspective transforms investing from anxious competition into confident progress toward personal financial independence. The most valuable investment insight isn't about which stocks to buy or which strategies to avoid. It's about measuring success absolutely rather than relatively. Because once you stop competing with others and start focusing on your own wealth building, you discover that getting rich steadily is more satisfying and more achievable than trying to get rich faster than everyone else. Robert learned that beating the market matters less than reaching financial independence, while James proved that focusing on absolute wealth building is the most reliable path to both financial success and peace of mind. Their contrasting experiences revealed why comparison is the enemy of compound returns, and why the investors who ignore relative performance often achieve the best absolute results. In the end, wealth building isn't a race against others. It's a journey toward personal financial security that becomes more enjoyable and more successful when you stop keeping score against other people's different games. The comparison prism is unlocked by recognizing that your only meaningful competitor is your former self, and the only scoreboard that matters is your net worth progression toward financial independence. The prisoners who escape comparison culture discover that absolute thinking provides both better financial results and greater emotional satisfaction than relative competition. They learn that getting richer slowly is a more reliable path to wealth than trying to get richer faster than others. And this understanding transforms investing from stressful competition into peaceful wealth accumulation that compounds over time into genuine financial security.